I would like to welcome you to our seminar today. My name is Tabby Perkins, and I work in the private banking group for Zions Bank. It is my privilege to help organize client seminars like this one. I will be your host today, and we will begin with opening remarks by Scott Anderson, President and CEO of Zions Bank.
Well, thank you, Tabby, and welcome everyone to the Zions Bank's quarterly economic market overview. As Tabby said, I'm Scott Anderson, and I'm President and CEO of Zions Bank, and we're thrilled to have you with us today. We're excited to present this update on the current conditions in our nation and in our region. The theme of today's event is the Great Reopening. Just over a year ago, the U.S. economy reeled from the impacts of COVID-19 pandemic, and the severity of the coronavirus forced dramatic actions to curtail infections and prevent death. And while some sectors of the economy were able to remain open at more limited levels, many businesses were forced to completely shut down. While these actions were necessary, the economic impact was severe, and many businesses were not able to survive. We've all been holding out hope for the time when the world would start returning to normal, and it appears that perhaps that time is now. Health statistics related to the pandemic are improving, and as of today, more than 160 million doses of the COVID-19 vaccine have been administered in America. And about 18% of the US population, or about 60 million Americans, are now fully vaccinated. And virus transmission rates and hospitalizations are dropping. And businesses are starting to reopen. The CDC said businesses, that people who are vaccinated can travel again. Restaurants are reopening in-person dining with increased capacity. Movie theaters and other performing arts centers are reopening, and Disneyland will reopen at the end of this month, though with some restrictions and capacity limitations. This great reopening of activity is helping to propel the economy forward into a period of strong growth. However, strong growth can also lead to inflation. And we're starting to see early signs that this may be on the way. Today, we will hear from Robert Spendlove, Zions Bank's senior economist, who will talk about some of the economic conditions we're seeing. Robert will be followed by Rich Mebius, the portfolio manager for Zions Wealth and Fiduciary Services, who will discuss current market trends. So now I'll turn the time back to Tabby for further introductions.
Thank you, Scott, for your insight and your leadership, not just at the bank, but within our community. At the end of the presentation today, we are going to do a Q&A session. Located at the bottom center of your screen is a Q&A box. Please submit questions as you have them throughout the presentation, and we will address as many as we can at the end, time permitting. Our first presenter is Robert Spendlove. Robert is an economic and public policy officer at Zions Bank, where he monitors and reports on economic indicators and public policy developments. He is known for his insight and understandable approach to explaining economics. Secondly, we will hear from Rich Mebius, who is a portfolio manager, as Scott mentioned, for Zions Wealth Management. Rich has over 15 years of experience in the financial services industry. He works with high net worth clients, institutions, nonprofit organizations, and other entities implementing investment strategies to meet client goals and help them manage risk. I will now turn the time over to Robert.
Thanks, Tabby. It's great to be with you today. I'm just going to share my screen real quick. It's just like Scott said, it truly is a remarkable time right now. And that's what I want to kind of focus on in my presentation, to give some insight into what we're seeing specifically with our economic growth and why we're seeing this impact from this great reopening. One of the ways to look at that is our monthly jobs report. And this is the report that comes out on the first Friday of every month from the Labor Department. And it was a real sign of the strong growth that we're seeing right now. So I want to point out a few of the points in here. Last month, or the previous month, so this would be February, we saw 380,000 jobs created in our country. We were expecting 625, came in at 916. So twice the number we saw the previous month and much higher than the forecast. The unemployment rate dropped from 6.2% down to 6%. And then when we look at where the jobs grew, private payrolls had grown at 435,000 in February, jumped to 780. And then this is a really important one, manufacturing, which is really the lifeblood of the economy, more than doubled from 21,000 to 53,000 in March. When we look at that in a graph, you can really see the direction that the economy is heading. So this is going back on the upper left to last summer. This was right as we started to come out of the big hit from the initial shock of the coronavirus, where we had large growth for July and August, and then it started to taper off. And actually in December, we actually saw job loss. So that trend was very troubling. But starting in January, we started to see the trend of job growth. And every month that growth has been accelerating. And I expect that acceleration will continue as we see the economy opening up and businesses coming back. However, it's important to note that we've still got a ways to go. So on the left, you can see that big impact. It was April of last year where we lost over 20 million jobs in 1 month, a total loss of over 22 million jobs in the US economy. However, we've been coming back, and you can see those big jumps in May and June, and then relatively smaller growth since then. And overall, we're still over 8 million jobs. We have 8 million fewer jobs today than we had before the pandemic started. So there's still some ways to go. If we saw the growth of this month, at least as much growth as we got in March, we'd still be about 10 months out from regaining the jobs lost during the early parts of the pandemic. When we look at it, kind of looking at the total change, you can see how remarkable the change has been. So this is going back, this is total employment or total non-farm employment, and going back to just before the Great Recession. You can see how generally job growth and losses happen in a more fluid fashion. But during this period, during the Great Recession, we lost about 8.7 million jobs. And it took about 4 years just to get back to where we were before. And then coming forward to the most recent period, you see how dramatic that drop is. But now we had that initial comeback where we are, at least it initially looked like we were in a V-shaped recovery. A little jump down as we had the virus forcing there to be more contractions and more business closings. But then we see that growth accelerating again. But also you see that gap that we still have to come back from just to be back to where we were pre-pandemic. Looking at where the jobs have grown is very interesting too. So this is looking at February to March. So this is the monthly job change in America. And you see the big growth is in leisure and hospitality, which added 280,000 jobs in from February to March, followed by government with 136,000. A lot of this is due to federal stimulus. A lot of that stimulus has been going to state and local government. And then, of course, construction has seen big growth of 110,000 in the month of March. However, when we look at the entire period, so this is looking back from February of last year to March of this year. So this is looking at the overall pandemic impact. Number one, you see that every sector is still down relative to where it was before the pandemic hit. But leisure and hospitality by far is still down the most. That's over 3 million jobs are still lost and have not come back yet. And that's more than a third of all jobs lost are in leisure and hospitality. But then we've also got education and health services. Education has been hit really hard in the pandemic. And government, while we saw a big jump last month, is still down significantly, down over 1 million compared to pre-pandemic. The unemployment rate is also looking very good. You can see that pre-pandemic, the unemployment rate was around 3.5%, so very low for the US. And just to point out, this shaded area in the middle is what we call full employment. It's the kind of the sweet spot in the economy. It's the situation where anyone who wants to find a job can find one, and employers can find the workers they need to be able to grow and expand. So this is really where we want to be aimed at, is this full employment level. We were below that going into the pandemic, and our biggest struggle a year ago was labor shortages. Then the pandemic hit, unemployment immediately overnight jumped to almost 15%, really the highest we've seen since the Great Depression. But then just as quickly as it jumped up, it's been dropping down. We're back down to 6% again. Not down to the level where we'd like to be. There's still too many people unemployed. Also, if you compare it not to the Great Recession, but the early 2000s recession, we've just now dropped below the high point of the early 2000s recession. So it shows that we still do have some ways to go to get back to where the kind of economic health that we saw before the pandemic. Another indicator is labor force participation. And this is essentially looking at if you take the entire population of an area, specifically the working age population, and then say of that population, how many people are either working or actively looking for a job. That's the labor force participation rate. And we've been in a long-term trend. Really the high point for our nation was in 2000, just over 67% labor participation. We've had long-term trend of dropping down, but then in 2016, as the economy started to really take off and improve, we saw that labor participation starting to trend up. But then the shock of the virus dropped it all the way from around 63% down to just over 60%. Now, here's the interesting thing. While the economy is coming back and people are coming back on the job, that labor participation has not come anywhere near where it was pre-pandemic. So while people are coming back, what this shows is that many people continue to be staying on the sidelines. They're neither working nor actively looking for a job anymore, so they wouldn't be reflected in that unemployment rate. And it's essentially a fundamental loss in our labor force. And so one of our policy goals should be to try to get this labor force participation back up to where it was pre-pandemic. When we break it down a little bit, it really shows an interesting trend. So this is looking at labor force participation by age group. So first, let's start off with the teen labor force participation in yellow. And you see that the teen labor dropped off the most, had a big shock going into the virus with shutdowns and slowdowns. However, the teen labor force participation recovered very well in late 2020 and is now essentially back to where it was before. So a big shock, but also a full return to pre-pandemic levels. When we jump up to the prime age labor force participation, this is people ages 25 to 54, not as dramatic of a drop, but also it kind of reflects the overall labor participation where it came back, but it's still at a lower level. The really remarkable one, look at the age 55 and older, the baby boomer generation, saw that a smaller, probably the smallest shock, initial shock of the shutdown, a brief recovery, But then this is right around August of last year, turned around and started dropping down and has been dropping ever since and is now below the low point of the shock. So where we're really seeing that drop is in the older workforce. Those 55 and older have continued to decide that maybe now is the time to leave the labor force. And this group is going to be hard, very difficult to bring back into the labor force. When we look at wage growth, this is another one of those really anomalous indicators. And I just want to bring this up because this is a situation where a drop in wage growth is a good sign. So normally wage growth goes up in good economic times and goes down in bad economic times until this year. And because of the unique dynamics of the recession, we saw a reversal of that, where when the economy shut down, 22 million people lose their jobs, wage growth jumps up to almost 8%. What this really was a reflection of was who was losing their jobs. And it was those 22 million were overwhelmingly lower paid, blue collar, hourly workers. And so when we pulled out those lower paid workers, statistical anomaly essentially dragged up that overall wage growth appearance. And so when you look at this graph, when you see wage growth going up dramatically, it means low wage workers are losing their jobs. When it goes down, it means those lower wage workers are coming back in to the economy. And so here we see a big loss of low wage workers, a return of them in the fall of last year, another jump. This was in late 2020 in December as the second wave of viruses hit. And then, so a really good sign is that in the last couple months, we're seeing that wage growth going back down. Again, it's a reflection that those lower paid workers are coming back in, which is a great sign for the overall labor market. Looking at GDP, or gross domestic product, we've seen dramatic fluctuations in GDP over the last year, dropping 31% in the second quarter of 2020, but then jumping up 33%. So just these dramatic increases and decreases in GDP. We're starting to level out again. In the fourth quarter, gross domestic product came in at 4.3%. However, when we look at overall GDP, this is looking at the absolute value of real gross domestic product. We're still below the pre-pandemic level that we saw in the fourth quarter of 2019. However, the consensus forecast for GDP is that we're going to see about 6% growth in GDP for the entire year of 2021. So I expect that we will surpass that pre-pandemic level in the next few months as the economy continues to accelerate with the grand reopening. One of the reasons for that, so the largest component of GDP is consumer spending. So consumer spending is about 2/3 of the entire economy. If consumers feel good, the economy will grow. And we saw a huge drop in consumer confidence when the pandemic hit, dropping from about 130, which is way above the level that people feel like the economy is prosperous, all the way down to the high 80s. This is an index produced by the Conference Board, and it's one of the most closely watched indicators of consumer confidence. Kind of stayed around that lower level ever since for the past year. But then just this month, we just got this data last week, we saw a huge jump in consumer confidence, almost just barely under that level that would indicate economic prosperity. So consumers are once again feeling good about the economy, feeling good about economic prospects and the future of the economy. So that's a great sign. Looking at another measure, this is the Institute for Supply Management collects this PMI, or Purchase Managers Index. So it's another survey, but this time it's done on the business side. And this data just came out yesterday, and it shows that the service sector, so that confidence of these purchasing managers is at an all-time high. We've never seen a measure of 63.7. Here, below 50 would indicate a contraction, and above 50 would indicate an expansion. You see the big contraction in the Great Recession, the contraction about a year ago in 2020, but now the service sector is very confident about future economic growth. Similarly, so the ISM has both a service sector and a manufacturing sector. This is the manufacturing sector. Again, you see that contraction or that drop going into the coronavirus recession. It actually started before that. We saw that downturn in manufacturing optimism going into the pandemic, but then was shocked going even further down when the pandemic hit. But look how quickly that's come back, and we're now not at an all-time high for the manufacturers index, but the highest we've seen in about 20 years. And again, a very strong level of nearly 65%. One of the reasons for that is the dramatic actions taken by the Federal Reserve and also by Congress with the CARES Act and the economic stimulus provided by the federal government. So one of the struggles that the Fed is running into, though, is the Federal Reserve has what's called a dual mandate. They were mandated by Congress in the 1970s to focus on two things. And there are two main areas that the Fed focuses on, and that's number one, full employment, and number two, low and stable prices or low inflation. And so we've kind of got this juxtaposition or struggle that the Fed is running into right now. On one side, while employment is coming back very strongly, that unemployment rate is still too high. We're still 8.4 million people below our pre-pandemic high, and that labor force participation is still lower than we'd like it to be. So the Fed is very concerned about focusing on economic growth and keeping this economic expansion going. But then on the other hand, what we've got is the prospect of future inflation. So this chart is the consumer price index, which is one of the main indicators of inflation that the Fed watches. The Fed's preferred level is right here in green at 2%. So that's really what they've always been trying to target, is 2% inflation. You can see before the Great Recession, we had inflation at about 5%. You can see how that high inflation created asset bubbles. It created bubbles in the housing market, created bubbles in the stock market in different areas. And when those bubbles get created, they then often pop and cause inflation to go way down, cause the economy to suffer. The Fed's trying to prevent this from happening again. And ever since the Great Recession, we've had relatively low and stable inflation, just like the Fed wanted. Now, if you look at the actual inflation indicator, the most recent data is February, is 1.7%. So at least according to the Fed, we're still below their target. However, the prospects for future inflation are just starting to emerge as the economy is growing so strongly, as growth is picking up. The concern is that this inflation could return back to those levels that we saw pre-Great Recession. So if we see that recession jumping up to 4 or 5%, the Fed is going to have to focus on that and is going to have to take action, probably by raising interest rates. And so that's one of the, we're not seeing in the data yet, but that's one of the fears going forward. Another one of the concerns is national debt. With all the federal stimulus, has been a godsend to the economy. However, that has represented $6 trillion of spending by the federal government. To put in perspective, the federal stimulus after the Great Recession was $800 billion. So this dwarfs the previous spending. And we do see that national debt is just about to surpass the all-time high that we saw coming out of World War II, and it's forecast to go up quite a bit more. The forecast period puts the national debt at up to 200% of the overall GDP. Looking regionally, it's really interesting to see what's going on around the region. So looking at job growth, both Idaho and Utah are the only two states in the entire country that have now fully come back or have added back all the jobs lost during the most recent recession. Idaho at 1%, Utah just behind it at 0.4%. And that really is remarkable when you look at some of the states around us. Nevada still down 10%, California 9%, New Mexico 9%. And then if you jump over, look at New York is down 10%. And the worst one, of course, Hawaii, still down 17%. So even with jobs coming back, Hawaii is still down 17%. And you can kind of see the trends that are going on with Nevada and Hawaii. It's due to their specialization in the travel and tourism area of the economy. California and Utah and Nevada has been because of severe restrictions due to trying to control the spread of the coronavirus. When we look at where those impacts by industry are happening, first in the state of Utah, the biggest impact is the natural resources sector, which saw a huge hit early last year and is struggling to come back. Other parts of the country are starting to come back, but Utah is taking longer to bring back those natural resources jobs. But then, of course, the biggest, largest impacted industry in Utah is leisure and hospitality, down 8.5%. On the other hand, though, we see big growth in construction, up 5%, and also in financial activity, up just under 5%. And then the other notable ones, professional business services. This is the kind of the higher paying service sector is up 3.8, and also trade, transportation, utilities is also up 3.8. Manufacturing is a good sign too, up 1.44%. These are all kind of our economic drivers, and they're all doing very well. In Idaho, the biggest impacted industry is information. Now, one thing to keep in mind is information is a very small industry. It's essentially publishing, motion picture production, telecommunications, internet service providers. So it's not what you would call, a lot of people think this is the tech sector, but it's really not. It's a very specialized and small industry. And then other services, another really small industry. This is essentially repair and mechanic services, auto repair, things like that. But we see huge growth in construction at 7.7% and financial activity at 6.8%. So some very strong growth in those areas in the Idaho economy. Looking at, so I just want to compare those two kind of extreme examples. Leisure and hospitality, there's no state that's back to where it was before the recession hit, but Idaho and Utah are very strong in kind of bringing that back, especially Idaho, only down 2.9% compared to a year ago. And again, when you look at other areas, you can really see how remarkable that is. You know, Nevada still down 30%, California down 33%. Look at Hawaii is down more than 40% in leisure and hospitality jobs relative to a year ago. When we look on the other side, though, on construction, again, Idaho and Utah are leading the nation in the growth in construction jobs. So just exploding construction growth in those jobs in those sectors at 8.2% and 5.9% respectively. A few other states are seeing similar growth. Washington, South Dakota, Arkansas, all seeing growth, but Idaho and Utah really lead the nation in that area. The unemployment rate, also Utah is the second lowest in the country, followed very closely by Idaho at 3.3%. By the way, South Dakota is the lowest unemployment rate in the nation, 2.9%. And then again, you see much higher unemployment in some of those same states that are still struggling, around 8% in Nevada, California, New York, and 10% in Hawaii. So looking at this labor force participation rate again, the green one is the US labor force participation that I talked about earlier. Then Idaho comes in at yellow and Utah in blue. And what we see is an interesting trend where initially Utah came back really fast and actually had a labor participation above the pre-pandemic level, but then has been dropping off ever since. And so the unemployment rate in Utah could be shielding the true impact, where again, when we see that drop in labor participation, it means more people are kind of staying on the sidelines and not engaging in the labor force in any way. Similar trend in Idaho, took a little bit longer to come back, jumped up, but then is also trailing off. So a similar dynamic happening in both Utah and Idaho. While labor participation is higher than the nation, it's dropping down as people kind of stay on the sidelines in greater numbers. However, overall economic growth, so this is comparing state level, state GDP growth to the national growth. Again, the US was 4.3%, and Utah was the third highest in the country, growing at 7.1%, much higher than the national average. Highest in the country was Texas at South Dakota at 9.9%, followed by Texas at 7.5%. Also, Idaho is seeing very strong economic growth as well. So our region continues to be a very strong growing economy as we come back from the impacts of the COVID. So one of those signs that I was talking about, those early signs of inflation, we're really seeing in the housing market. So this is going back to 1996, looking at the median home value of the US in green, of Idaho in yellow, and of Utah in blue. So if you look right here, remember the housing bubble of 2006 through 2007. And you can see how those housing prices rose up, topped off, and then dropped down after that. Where we are today in Utah, the median home price is now $408,000. Idaho, $360,000, way above the US price of $272,000. And what's very concerning to me is kind of the shape of these curves, how not only are they going up, but the increases or those appreciation rates are going up. And you could really see that in the next one. So this is looking at those year over year growth rates in home prices, where the US is going up at just under 10%, Utah just under 15%, and Idaho just shockingly at almost 21% annual price appreciation. In Idaho, it's the highest home price appreciation we've seen in 43 years. And in Utah, we're almost back to the pre-Great Recession appreciation levels. Now, there's an interesting dynamic, and you really see it. So if you kind of draw a line right here, this is when the pandemic hit. So we had housing price appreciation actually dropping down a little bit. So the prices were still going up, but the rates of those prices going up was dropping down. But then the pandemic hit, and it was kind of a perfect storm of impacts, where we had the drop in interest rates because the Fed dropped Fed funds rate down to zero. Then you had the change in demand as people wanted to buy more houses and kind of get out of rental and city living. And then the third one that you really see in Idaho and Utah is the impact of in-migration as people are moving to the Intermountain West from areas of the East and West Coast. And so that's really adding to that, those increases and that inflationary pressure of housing prices going up. So kind of wrapping it up, putting it all together, while the economy over the last year has been very difficult, but what we've started seeing just in the last few weeks is the economy is accelerating, growth is accelerating. Those sectors that were really severely impacted are starting to come back, like leisure and hospitality, like travel and tourism, are finally starting to come back with this great reopening. Growth will continue to be very strong as the vaccine continues to go to more people and markets continue to open. But that downside risk, that struggle that I'm seeing, and this is probably about 3 or 4 months out, is this very high growth is showing signs of creating inflationary pressure. And so that will be something that, again, it's something the Fed and policymakers in Washington are watching very closely. The big question is whether that inflation is going to be transitory or temporary, or whether it becomes longer term. And that will decide to what degree the Fed has to react to that inflation. And then within our region, Utah and Idaho continue to be very strong, leading the nation in a number of different areas. But there are some of those risks like those housing price appreciation numbers, and also that labor force participation not being kind of going in the wrong direction from where I'd like to see. But overall, the economy is looking very strong right now, and the prospects for growth going into the middle and the spring and summer months is very strong. So I'm just going to quickly turn it over to Rich now. Rich, if you'd like to, Rich Mebius will now give an overview of the market.
Great, thanks, Robert. Appreciate that. Okay, can you see that okay? Great. So like Robert mentioned, this theme is the great reopening. The equity and really fixed income markets are showing that reopening as well. So today I wanted to go over, just review market performance and break it down by sector, what markets can look like the following year after a strong recovery. And then as we were talking about higher yields, inflation, how does that impact bonds and stocks? Also, on the bond side, why we would own bonds in a portfolio, and talk about some of the other fundamentals that we look at in putting a portfolio together. And then finally, we'll wrap up with just our outlook for the rest of the year, and then recap performance for our strategic accounts through the first quarter. So getting into it, let's look at what market returns were for the first quarter. Stocks really started out the first quarter strongly. They've continued that into the second quarter. We're going to keep watching this, but it's really encouraging to see that the S&P 500 has broke through 4,000 for the first time. Dow Jones is sitting at all-time highs. The tech-heavy NASDAQ is fairly close, not at all-time highs, but we're pretty close there. Looking at small caps, that was one of really the more risky areas of the market. We started to see that rotation into small caps in November, which continued again through the first quarter. So showing about 13% returns in that category. Domestically, mid cap and large cap also did well. A lot of the returns in international markets, Europe and emerging markets in particular, didn't do as well. Some of this is, again, increasing rates in COVID, new cases, also a slower rollout in vaccines as opposed to the US. One thing to note, though, on that far right side is high quality bonds. So the first quarter of this year, we saw one of the worst performance out of high quality bonds on record. And we'll talk a little bit more about that and what was driving that. Municipal bonds held up a little bit better. There's just less supply there. Also, there's some tax advantages, so it didn't get quite the downside that high quality corporate bonds had in that first quarter. Looking at this chart, what I wanted to do was compare first quarter sector performance with the full year of 2020. So you can see that there has been a pretty big reversal in what worked last year and what is working so far this year. Energy in particular is the big driver of returns this year, coming in at 29%. It's still down, but it's making some progress there. Last year, energy was down 37%. There was a time period last year where oil and energy companies actually had to pay companies to take their oil. We've certainly seen a reversal of that. The other reversal that we've seen is in technology. So this year, technology is only up just under 2%, where last year technology was the big driver of returns. So for us, when we look at this, it's really healthy to see this rotation where the market is not being driven by a handful of companies, but you're starting to see all these companies enjoying this reopening and benefiting from that. So one of the questions that investors ask is, again, last year with a strong return, what can we expect this year? And if some of you listened to the call early this year, we talked a little bit about this, and I wanted to break this down. There's a lot going on, so let me walk through this chart with you. The sort of light purple, light blue column is the first year returns tracked from the market low. So we're looking at time periods when the S&P 500 declined by 25% or more. So again, we're tracking from that low and then what the returns were from that low in that first year. The darker blue is the following 12 months after that time period. So really across the board, you can see that we still get returns in the equity market that following year. The caveat to keep in mind for investors is the yellow drawdown in the second year. If you look on average on that right side, average correction in the year is about 10%. So as investors, we just need to realize that any year we should expect to see a correction of at least 10%. And in that second year following a rally, again, we do see that. But the average return on the S&P has been just under 13%. So one of the factors that we look at is what we call an equity risk premium. And ultimately, stock prices are a function of their future earnings and the interest rates. So the equity risk premium is really that excess return that you get when you invest in stocks over, say, in this case, the 10-year Treasury yield. So what you want to see is how much additional return can I get by investing in a risky asset like stocks. When we looked at this chart earlier this year, you can see, let me get a pointer here. So earlier this year, we saw stocks were certainly above the average and they looked more attractive to bonds. Right now, we're a little bit below the average, and a lot of that has to do with yields have gone higher on bonds. We're starting to see some of that inflation fears creep in. So really, at this point, it's looking. Investors are going to look to see if we can get higher returns out of stocks now that Treasury yields are a little bit higher. Now, despite this recent change in stocks attractive relative to bonds, we still expect to have really strong earnings in the first quarter. And as a portfolio, we're still positioned slightly overweight on equities. Speaking of earnings, we expect to see earnings up about 24% year over year. It's important to note that this is going to be the first quarter where the comparison is in the pandemic. So that hurdle is pretty low. So we expect to see strong returns or strong earnings from that. So one of the key things that we will be looking at is what are the expectations for the rest of the year, and how does it actually compare to the first quarter of 2019? Okay, so continuing to look at bond yields, this is a chart that we're looking at, and we've got labeled down here. Every time the Treasury yields have risen more than 100 basis points, so more than 1%. And it's interesting to note that in all of these time periods, the equity market still had a return. Some of those returns were flat, some we did have strong positive returns, but just because rates move higher doesn't mean that we have to have negative returns in stocks. One of the things that I wanted to look at instead of the graph was to look at the actual numbers. So breaking down some of these different time periods where we had the bond market sell off and rates went higher. Again, that's important to remember. You know, if you go back to the Finance 101, as bond prices go down, interest rates go up, and as interest rates go down, those bond prices move up. So right now we're just looking at the period where those bond prices, excuse me, where those bond prices have gone down, yields have gone up, and then that last column is the S&P 500 return during that time period. So again, you can see that we do see, and you can get positive returns from the S&P 500 during rising rate time periods. So the big question then is why own bonds in a portfolio? Right now, again, we still are at historical low rates. As many investors know, it's painful on that aspect. So again, why do we own bonds? This slide is looking at sort of the reverse of what we were already looking at. We were looking at when bond prices fluctuate, how does that impact stocks? This is the flip side of that. So when stock prices sell off, how does that impact bonds, and what does that look like on your bond portfolio? So on this slide, we are looking at periods where the S&P has declined by 10% or more, with a backdrop of that of bond market returns. If you look on the bottom, this was really the beginning of the pandemic and the shutdown of essentially the economy. The stock market returns during that period were down 34%. Bond market return, while negative, was just down slightly, down a little less than 1%. And in all these time periods, you can see how bonds have held up during periods of extreme volatility. This is why we own bonds in a portfolio. It also provides for rebalancing when we have a market sell-off, where we can trim off something that's held value or possibly even gone up, trim that and add it to stocks. So we own more shares when we get that recovery. One of the slides that is my favorite, if you listen to the last call, I talked about this in a lot of client meetings. If you've been in those with me, I like to talk about this. This slide is probably my favorite talking point. And if you remember anything from my presentation, it would be this, which is really staying hold to the fundamentals, which is time in the market is really the most important investment strategy. And market timing is extremely difficult to do on a consistent basis. So when we look at this chart here, this goes back for the last 25 years since 1995, and we're just looking at the S&P 500. If you had invested in the S&P 500 in early January, you had an annualized just over 8% return since then. Now, if you missed the 5 best days during that 25 years, you lost about 2% annualized return over that time period. That's a big number by missing the 5 best days. Nobody knows when those 5 best days are going to happen. The only way that you can really benefit from that is being invested. If you miss the 10 best days, your return drops even more dramatically, and so on. The other thing to note is most of these best days occur within 2 weeks of the low. So really, when it seems the darkest, within 2 weeks or so, that's when you're going to get one of those best days, and you really want to be invested in that and take advantage of that. Okay, just to wrap up here really quickly, wanted to look at our outlook and some valuations. As Robert mentioned, we are looking at GDP. Earlier, the forecast was somewhere between 5 and 5.5%. Right now, it's been moved up to somewhere between 6.25 and 6.75%. Really, the rest of the world, we've remained unchanged in those targets. Again, a lot of that is just we're still in the pandemic. Vaccine rollout hasn't been as robust in the rest of the world. So for the time being, we've kept those targets relatively unchanged. As far as the earnings per share go, again, I touched on that. We're going to start seeing some of those numbers coming out next week and over the next month, really. And we've moved our adjustments up. We're expecting this year to be somewhere in that 175 to just under 178 on that earnings. S&P, we also moved up. As you'll note, we're pretty close to that bottom target on our forecast. We'll be revisiting this probably during the summer months, but that is our forecast at this point. One last slide before we open it up for questions. I wanted to just highlight our first quarter investment performance for our strategies. Year to date, across all of our strategies, we're really seeing strong returns up to this point. Last year, if you looked in our conservative portfolios, we were a little under our benchmarks, preferring to be a little more conservative on fixed income and take our risk on the equity side. This year, being conservative in that fixed income has really benefited us. And across all of our strategies, we're seeing positive returns for that first quarter. So with that, let me switch it to our questions, and Tabby will take it from there.
All right, thank you, Rich. Rich and Robert are both, I'm feeling really optimistic with your messages, with the market, especially here in Utah and Idaho, and the way that investments are moving. That is fantastic. So with the time that we have, I'm going to try to do 2 questions for each of you. The first one is to Robert. What are the risks to the projected economic growth?
That's interesting. When we talk about risk in an economic sense, we often talk about, when people think about risk, they think about the downside risks. But in economics, we talk about downside and upside risks. And so on the just kind of looking at the downside risk, and I've said this before, but the economy has been for the last year and will continue to be driven by the virus and by our ability to treat the virus. And so if we are not able to stay ahead of it, right now we are, and things are looking really good, but there are other parts of the world where they're starting in a fourth wave and having to restart shutdowns and close down business activity. If that were to take hold in the US, that would definitely be a downside risk that would slow that growth and keep us from growing the way we expect. I would say that what we're experiencing right now is really that upside risk. We're revising up our forecasts because the growth is so strong. Vaccines are ahead of schedule. Businesses are reopening quicker than we thought. The president has actually moved up the time when everyone in the country will qualify for a vaccine by 2 weeks. It's going to be about 2 weeks from, or a week or two from today. And so we're really experiencing that upside risk and seeing growth much higher and faster than we had anticipated.
Okay, great. The second question for you that someone asked is, what was the inflation rate along the Wasatch Front during 2020? Maybe even if you can comment on Idaho and Utah as well.
Yeah, so we don't have the exact numbers for that inflation rate, but kind of those indicators of that inflation, you really see with that housing price appreciation. That's a good kind of proxy for that inflation. And so we are seeing inflation in the Intermountain West start to accelerate. We're seeing it in home prices. We're seeing it in energy prices, specifically gas prices are starting to go up. So I would say that it would be, while we don't have the exact number, it would be definitely north of that 1.7% that we're seeing nationally. I would say it's probably closer to maybe 3% in the local region.
Okay, great. And then two questions for Rich. The first one is, what will international markets do versus the US? It's kind of some of the key points on that.
Yeah, we do expect to see the US continue to outperform international markets, in particular, international developed markets. So that's going to be mostly Europe. Again, like Robert said, the US and really the world is going to be driven by the coronavirus. So you can see Europe is really struggling with that. They had some more shutdowns or lockdowns during Easter holiday. And so as you see the rollout there stagnate, we expect their economy to stagnate, which would translate to their markets. Emerging markets is probably a little bit different. There is still some commodities exposure, which as inflation ticks up, they should benefit. But we continue to see the US be the primary driver of really global growth. And in our portfolios, we are significantly overweight domestic equities.
There are a bunch of questions that came in last minute, so we will get to those individually, but I think to kind of sum up a bunch of them, for Rich, what advice do you have for investors right now? We have a couple of people asking about municipal bonds, gold, and with kind of predicted inflation, what's kind of the high points you leave with clients? What should they be investing in?
Yeah, as long as I have been investing with clients, talking about markets, the question always comes up of the market's at a new high. I'm scared to invest my money right now. And, we're kind of experiencing that right now. But we've always had market highs and the market has had some periods of volatility and then it's moved higher. Again, I think the key, going back to that chart of staying invested, is have a plan, have a good strategy on that plan, and then how does that allocation fit? You know, what's the appropriate mix of stocks and bonds, and then revisit that with your team to make sure that you're on track. So it's more about, here's my spending. Is my spending on track? Or did I spend more? Or did I spend less? How are my investments working based on the projections that we've had? Am I on track? That's really the most important thing. I mean, there's, again, it goes back to those fundamentals and the basics on putting a portfolio together. It's not always, you know, the real fun, exciting things that you want to talk about, but it's really that tried and true method of getting you where you need to be with the least amount of risk.
Perfect. Okay, we are at 1 o'clock, so I just wanted to say a big thank you to Robert and Rich. The work that they do is really valuable. That kind of insight, I think, is critical at this time. If you have follow-up questions, we're going to be sending you an email with a survey we'd love for you to fill out. Also, we plan to send out the slides and the recording. So anyone that wasn't able to listen to all of it, or if you want to reference back. Thank you for joining us today. Thank you for your business and continuing to trust us with your banking needs. We'll host this quarterly, so be on the lookout for further invitations. Thank you.